Okay, wonderful. Welcome everybody to today's Lunch and Learn. My name is Joel Landon. I'm with Heritage IRA, and I've got Reed Myers with us today from Myers Investment Group. Reed, how are you doing?
Doing all right. Little
Good.
early Hawaii time, but yeah, ready to go.
That's right. Your Hawaii time, what is it? 8 a.m. over there right now?
8 a.m. Yeah.
Okay, awesome. Well, we're happy to have you here, and I'm sure, we'll make it worth your time for sure. But thank you everybody for taking the time out of your day to join us live. I know that we're going to have some people here today tuning in during their lunch break, but we also know that there's going to be some folks listening to this as a recording. And again, we're just really grateful that you're taking some time to tune into some great information, great content tied to self-directing retirement funds and specifically investing those funds in private mortgages. So that's what we're going to be discussing today. And I'm sure we'll distill that and break it down and have some tangents along the way. But for the next 45 minutes, we'll be excited to share this with you. I always like to just break down a little bit of what you can expect as an attendee. So I've got everybody on mute, everybody's cameras off, but those attending live, you can actually submit questions, comments in the chat. We're going to be reviewing that today. If you've got questions, don't hold back. Drop those in the chat. We'll be reviewing them and we're happy to pause in between and answer your questions for you. This should run about 45 minutes. I know that Reed's going to have some slides for us to take a look at, especially on the case studies, which we're going to review here towards the end. But before we kick it off and hear a little bit more from Reed, I'd love to just read a disclaimer. Very customary. I like to read this each week. It takes me just about a minute to read through. It's really simple. But before we begin, I want to briefly note that today's discussion is for educational and informational purposes only. So Heritage IRA does not provide tax, legal, or investment advice, and we do not endorse or recommend any specific investment sponsor or offering. Any discussion, potential returns, tax treatment, or strategies, including Roth conversions of alternative asset investing in general in nature, and may not apply to you in your individual situation. All investments involve risk, right? Including the potential loss of principal. We encourage all attendees to consult with their CPA, tax advisor, or financial professional before making any investment or tax-related decisions. So with that out of the way, Reed, so happy to have you here. Please share a little bit about yourself. Let's make sure everybody listening today who may not know you has a chance to hear from you. Go ahead.
Sure. Yeah. Thanks, Joel. Appreciate you having us. Yeah. Again, my name is Reed Myers. I'm with Myers Capital. So we're a mortgage company based out of Honolulu, Hawaii. We have a capital management company called Myers Investment Group. So Myers Capital was actually started in 1998 by my father, shortly after getting involved with the company. He ended up retiring and I ended up having this crazy idea. I wanted to expand to Hawaii, where I was from originally, and was fortunate enough to be able to do that. Living the dream. And as so many people say, it's not without its challenges and the obstacles that we have, being out here in Hawaii. But we've been very fortunate to be able to do the work that we do actually across the states, all from Hawaii. So and Myers Capital, we're a mortgage banking company. Again, been around since 1998, and I've been in the financial mortgage industry for almost 20 years now. First Investment Group is basically our capital management arm of the company, where we manage capital for outside investors, and we help them deploy it in alternative assets, specifically what we call passive mortgage investments. And we'll go into a lot more detail about that. But yeah, I live out here in Honolulu with my wife and two boys, two young boys, and actually met Joel years ago. I'm a self-directed IRA investor myself, and that's how we got connected. He actually helped me set up one of my first self-directed IRAs, and I'm very fortunate to have that relationship, be able to collaborate with him. So yeah, excited to be here. Thanks, Joel.
You bet, Reed. Yeah, super happy to have you sharing your experience with us. And so cool to hear that this is a second generation company, essentially. Like you said, your dad started things and you've taken it and expanded it. So that's really awesome. Also love to hear that you've got a couple decades worth of experience in financial services. So I know that, you come with the credibility essentially to help share information and educate others on the call today. So appreciate that. Let's get right into it. I've got questions to help us along the way, break down some specifics for the attendees. And I figured why not kick it off with some fundamentals here, if you don't mind, those investors unfamiliar with private mortgage investing, one of your specialties. Can you explain how the underlying economics work in general?
Sure. Yeah, basically private mortgage investing, if you're not familiar, easiest way to think about it is you're become a mortgage lender, but you're not doing it by yourself. So with a mortgage, of course, the lender will lend the borrower money. They'll take a lien against the collateral, real estate in this case, and then you will earn a certain yield based on the terms of that note. So it's a good focus for investors who are looking for kind of that income play. They're more focused on consistent residual income based on their capital investment. And it's the unique thing is it's all backed by an asset. So being in debt, you not in debt, but being in the debt realm, basically your principal is protected by the asset, which is the real estate collateral.
I mean, it sounds almost like traditional mortgage lending, and the investor actually becomes the institution, like the financial institution that's providing the financing for the property. Could it be looked at that way, essentially?
Yes, but it's not institutional and the
Yeah.
returns are a whole lot higher.
Yeah.
Right now, you can get a consumer mortgage, right, for about 5.5%. In that realm, our returns are substantially higher, and there's a reason why behind that, and we'll kind of get into that. But basically, we're not lending to consumers. We all probably had, most of us on this call have had or owned homes and probably taken out residential consumer mortgages with Fannie Mae, Freddie Mac, et cetera. This is not that. This is short-term mortgages designed to be deployed to real estate investors, commercial property owners, builders, developers, people like that. So these are
Yeah.
very much business transactions and they're short term. So
Okay.
most of our private mortgage notes are typically 12 months.
Oh, wow. Okay. Yeah, definitely significantly shorter than institutional
Yeah,
financing that
about
we're doing.
29 years shorter.
Exactly.
Yeah.
Right on. Well, cool. Let's just keep on rolling here. So, why would you say passive mortgage investing has grown so rapidly in recent years?
I mean, I'd say it's the advent of technology and really the education out there, much aligned with your industry, the self-directed IRA custodial industry. A lot more people are looking for alternative investments. Now that's a big bucket, but they're more confident in being able to figure out things on their own outside of what they would typically being offered, through the traditional financial advisory route. So I think a lot of it has to do with that, just education, transparency of knowledge, being able to find and this is not for everybody, right? If you're wanting to take on trying to invest in alternative assets or do your own investments outside your financial advisor, it takes homework, right? So not everybody's willing and able to do that. But I think more and more the transparency of information, the data that's out there, the educational material, much like we're putting on today, that has been a big flow behind the interest that we've seen in, even things like crowdfunding. That's not what we do, but crowdfunding, investing so much money maybe through your self-directed IRA and peer-to-peer lending, things like that, real estate syndications as well. There's just a lot more information out there that allows people to kind of sink their teeth in it and really start to get comfortable with a particular alternative asset. So, and that's trickled down to us in the private lending space. Absolutely.
Well, yeah, I think, access to information is what's driving so much exposure to these types of alternatives. And I love it. And I was on your website, I've been on it a few times. And I noticed that not only do you provide resources there for individuals that are either curious, might be new to the asset class, but it seems like you also offer up consultation. Like you're actually willing to have a phone call with an investor, discuss the asset class, maybe find out if it fits into their wheelhouse. Is that right?
Yeah. Yeah. So I actually had a meeting yesterday with a vendor that we were looking to do some marketing with. And one of the things I told them is, we will tell people when it doesn't seem like it's right for them. And I've gone as far as to say, maybe this isn't quite the good fit. Maybe right now, maybe down the line. You have to be, I hesitate to say this, but a little bit more sophisticated, but you got to be willing to put in the work. And it has to be a good working relationship. So if it's not a good fit from the start, there are plenty of, options to choose from. But I have no problem telling people that maybe this isn't quite the right time. It's got to be a good fit. And that's one of the things we go through. I wouldn't call it an advisory session. I'm not a financial advisor. I'm not there to look at everything you have going on. I'm there to go through to see if what we are doing maybe aligns with your current strategy or your proposed strategy. So, and again, nothing against the traditional routes. I still have portfolio in stocks and bonds and things like that. But this is a very interesting way to supplement what you may already have. And a lot of times our investors will start with a certain amount and they see how things are going, they see the progression, they see the communication, they see the white glove kind of service that we provide, and they end up adding to it. And that's kind of a natural attrition, if you would call it. And it's a building and continuing of our relationship.
That's awesome. Cool. How would you differentiate mortgage investing with, say, owning rental property? I'm going to put you on the spot, but I'm sure you've got some experience, maybe not firsthand, maybe indirectly with, those types of industries, owning rental properties, REITs. Could you make a little bit of a comparison or maybe differentiate mortgage investing from, say, rental property ownership?
Yeah, sure. I mean, I can attest to firsthand with my own personal portfolio. Again, I love real estate. I love owning it. There's pros and cons to everything. What you'll find is as you get to a certain point, it requires a lot more. It becomes a part-time job, even with a property manager. So, like my wife and I, we manage most of our portfolio, and I always talk to her about, how are things going? She's like, I'm so busy, I'm so busy, I'm so busy. It's like this is like a part-time job. I'm like, yeah, I know. That's what we signed up for. It's got its benefits, tax benefits, depreciation, things like that. You got, 1031 exchanges. REITs, what is a REIT? REIT is a real estate investment trust. I used to work for one. That was actually one of my first jobs out of college. A lot of people see it and know it as, well, you get to participate as an owner in large commercial projects, right? You kind of see that, these big publicly traded REITs. There are also mortgage REITs, by the way. Now, they don't typically return the type of yields that we have. That's essentially kind of what we have, but we're not publicly traded. But basically, when you invest into a REIT, you're investing into a basket. Let's just say it's a real estate REIT. You're investing into a basket of real estate properties that it owns. On a smaller level, you could call it real estate syndications, which I'm sure a lot of our audience is probably pretty familiar with. Basically means you participate as a part owner, typically a GP, general partner, LP, limited partner class, acquiring and usually repositioning real estate. But what makes it different, mortgage investing different from owning rental property real estate? It's more hands off with different tax implications. One of the big ones that you would get when you acquire and manage real estate, you get tax depreciation. You can defer your capital gains by 1031 exchanges, but it just requires more hands-on management, right? So a lot of our capital investors that invest with us come from the real estate world, believe it or not. And they've done probably very well with real estate, but maybe they're at a point in their life where they want to take some chips off the table, want to settle down and really still be involved with real estate, but not the active management of real estate. So that's where we actually see quite a bit of our investors come from that realm. Basically, it's a way to earn returns backed by real estate, but without all the active management of it.
Appreciate you breaking that down, and awesome to hear that you got the firsthand experience. So what would you say makes this structure semi-liquid? I'm going to go out on a limb and say that this is probably a semi-liquid opportunity for an investor. And what should investors understand about that term?
Yeah. So we call it semi-liquid because normally the securities that we're investing in are short-term mortgage notes, right?
Yep.
So on average, 9 to 12 months, somewhere around there. So because of that, if you invest in direct investments, like you actually acquire a whole mortgage or a fraction of it, you're really only tied to the term of that loan, right? Unless the
Okay.
borrower needs to extend, assuming that you approve it. So it's semi-liquid in that sense. It's not fully liquid because you can't just easily sell it and hit a button and sell your shares, right? Much like
Right.
you would in the public markets. That's a something to consider. It's not long term in that you're not getting involved in other alternative assets, investments like venture capital or long-term
Right.
real estate syndications where your money might be tied up for 5, 7, 10 years, right? So
Yep.
there's that differentiator. But normally I always tell people don't invest in this if you're needing to be extremely liquid over the next 12, maybe even 18 months to be safe. Now, with that being said, we're a very boutique firm, very hands-on. I have had clients that invested into real estate notes and they had maybe needed to get out for some emergency reason. Now we'll come in, assess the situation, and if we can, there's no guarantees, but if we can, we'll buy them out.
Right.
So there's that availability. Of course, nothing's 100% guaranteed, but I always try to help because a lot of these mortgages, and I guess we'll go into more detail on it later, these are loans that we've already have on our balance sheet. We already have them on our books. We've already lent the borrower the money. So we stand by it. We already stand by it. We have no problem continuing to earn the rate of return that we're already earning, but it doesn't help us grow our business or bring on new clients, such as new capital investors. So we'll have at any given time active opportunities, a lot of them on our website, not all of them, but these are loans on our books. So if we had to take it back because a borrower's liquidity demanded it, then we'll certainly look at it. And we've done that in the past.
Yeah, I love that. That's actually kind of rare. Me being in my seat on the self-directed retirement account side, it's not every day that you can move into a partnership with you, as the sponsor or the manager of these opportunities where you actually have it on your books, like you said. You've done essentially the underwriting and you've determined that it is a great opportunity, an opportunity for you guys to put your own capital into the investment. So I can imagine that gives investors a lot of peace of mind. And again, no promises, but you do have that ability to buy out the investor if that ever came to fruition. Not saying again that that's something that's a part of your, common business practice, but
Right. Yeah.
speaks
I mean, when
volumes,
you invest into a deal, you invest because you want to earn the
right?
income and the yield, right? So,
Yeah,
but yeah, life happens, things like that. But you want to
yeah,
try to plan for that and have your cash, your powder dry for any emergency situations that kind of goes along with being a sophisticated investor to some degree. Don't invest your last penny. Highly unadvised.
yeah, no, for sure. Okay, great. Well, let's move into some other pieces of conversation today. These questions are more driven around income and performance. How are investors generating steady monthly and quarterly income through this specific asset class?
Yeah. Basically, so a lot of these mortgages are interest is paid monthly on it. So there's two different ways to invest with us. I can talk about in detail about one of them. The other one I can talk about privately if we kind of build a relationship. This has to do with securities regulations. But basically, you have more of a direct investment where you actually invest and own the whole mortgage itself. Let's just say it's $1,000. You could take the entire thing if it's available or take a fraction of it. Minimum investments, by the way, are 150,000. Can be invested with either cash accounts or self-directed IRA accounts is the most common. So the direct investment, when the borrower makes their monthly payment, you get the interest. Or if you invest through a self-directed IRA, it just goes right back into your self-directed IRA account. Now that's not a distribution, that's just your investment actually earning yield, right? Now, another avenue, I can talk about it lightly, but it's basically think about instead of just investing into one mortgage, you're investing into a pool of mortgages. Now,
Yeah,
that format is called a fund. Those can be paid out in different manners and more like a REIT, let's just say.
really
Anybody wants more detail on the pooled version, I have to talk about that offline. I have to build a relationship with them, etc.
makes sense. Yeah, makes perfect sense. So direct ownership versus participating in a fund or a pool.
Right.
I'm really curious about the minimum. I appreciate you sharing that minimum is $150,000. Have you had clients come to you or investors who may fall short of that? Let's say a self-directed IRA owner has $75,000 in their IRA. They really like the opportunities that you have. They
Mhm.
love the 9 to 12 month term. Maybe they bring in a partner. They have $75,000. They put a joint venture together or, establish an LLC, essentially 50-50 ownership. Would
Mhm.
you take that investor on, or would it look a little different?
Yeah, we've done that in the past. I mean, sometimes we've got a few small loans. Like we have one right now that's 125,000. That's the entire loan amount size.
Got it.
Yeah, we've done that. Basically we want to number one, see is it suitable for you and or your business partner and kind of understand the relationship. If we just broadly advertise, oh, we'll take $25,000 minimums, it's not very efficient for us as a company. I have a
Yeah,
business to run, I've got payroll to pay, I've got office space to pay for.
sure.
There's more friction in that. But yeah, absolutely. If I feel like this is a good relationship and I can see that the pieces will align, we've done that in the past.
That's great. No, I think it speaks a lot to just you as a professional in your shop, and you're just not taking anybody that comes through the door. And so I think that that's unique in the investment space, honestly. Well, what type of borrowers or collateral typically back these loans, if you don't mind talking about that?
Yeah, yeah, this kind of gets into underwriting. So we lend in about 42 states. Our main focuses, however, are I would say maybe 60%, maybe sometimes as high as 70% in Hawaii. Now, because of where our company was formed, we have a lot of relationships, have done hundreds, if not thousands, of loans throughout the Carolinas, the Southeast, the South. So we really like Northwest, particularly Washington, Idaho. We like New Mexico, Texas. We focus primarily on mid-Atlantic through the South, Southeast. But even then, there are pockets where we've underwritten deals and we've got a few loans on our books in other states because it made so much sense. It made too much sense not to do the loan. So we had to do extra work, due diligence, etc. But we got very comfortable. We might, in states that we're not always extraordinarily active in, we just get more conservative. So, but it still doesn't mean we give up on underwriting. In fact, we dial in more. So what kind of borrowers are we lending to? Again, these are like real estate developers, commercial property owners, builders, real estate investors. Basically, asset class wise, we're pretty agnostic. Again, depending on certain asset classes, we get more conservative. So typically we break it down to 1 to 4 units. So like a single family through a quad. A multifamily is anything 5 units on up. We'll lend on that. Mixed use, light industrial slash warehouse properties. Those are very popular right now in certain areas and very high demand. And then you get into condos in Hawaii, smaller asset or a more defined asset class behind condos would be legal short-term rental condos. We call those condo hotels in here in Hawaii. Those are very active, especially for out-of-state and in-state investors. And then we also do some land and land development type deals, again, with more strict conservative underwriting. So
That's a diverse class.
we generally stay away from office. I mean, you read about all this, all the headlines in the news. That's really for big office buildings, but we're very cautious with that. And we've got enough business as it is to just stay away from that as we see the dust kind of settle and things start to transition.
Speaking of being cautious, let's jump into maybe some of the risk mitigation and mortgage investing. It obviously sounds really attractive, but what would you say are some of the risks?
Yeah, I mean, with any investment, you're always going to have risk, right? As far as thinking about debt, which is what the role that we play, as opposed to equity. Equity is the first piece to get lost in an investment, right? So think about just somebody buying $1 million property. That's close to an average single family home right now on Oahu. If a borrower puts down 30% and the lender lends them 700,000, deal goes sideways, or the borrower can't perform on their business strategy, the first thing they get lost is their 30%. That's their equity. Now, in that example, if we come in and we're owed 700,000, we're first in line. Most of these are first lien positions. We're first in line to capture the asset. So debt is actually safer than equity in that regards, especially when you're backing it by a hard asset, right? Real estate. There's always going to be some sort of intrinsic value in the real estate. Risk, yeah, I mean there's always risk, and that's the job of underwriting and sizing up the deal properly. You have borrower risk, which means like repayment, credit risk, performance, real estate expertise and knowledge to be able to execute on their business strategy. Because most of these loans that we're doing for borrowers, they're looking to transition or value add the project of in some way, right? They're usually not just buying it and then renting it and that's it. If they're doing that, I can go get them a much better loan than at much better rates than
Right.
what we're charging here. Like our
Lower.
floor note rate is 13%.
Dang.
So if the property's turnkey, I'm just going to go get them a long-term 30-year fixed rental loan in the sixes, right? I do that anyway for my clients, and I always tell them like, we're not going to go to private lending unless you have to. If I can get you better rates and better terms here, again, this is me playing the loan officer hat and trying to help my borrower. We go that route. So back to risk, basically, yeah, borrower can maybe not perform. We talked about borrower risk. You have collateral risk. Okay, well, what's the property? What kind of shape is it in? What kind of zoning do we have going on? Are there any changes in regulations? Like on Maui right now, we've got a short-term rental ban in the works. That's something to be aware of. That's having a dramatic effect on certain Maui condos, certain ones. So you got to know these things, right? But at the end of the day, you look at, well, if certain things are more risky, what do? We either just walk from the deal and don't lend them the money, or we start to get more and more and more conservative. The main tool that we have to bring down risk is by just lending them less money in regards to the value of the property. So back to that original example, $1 million purchase price, borrower comes in with 30%. Well, if it's a riskier type deal, either again we'll walk, or if we find other compensating factors as we talk about, this could be a borrower's liquidity, their assets, their schedule of real estate, their credit scores, their experience, a number of different things. But our biggest tool we have is just lend them less. So maybe we lend them 50 cents on the dollar instead of 70, right?
Yeah.
So that's a big part of how we mitigate it. One other way that's very common is we'll cross collateralize. So if we're looking at a property and a borrower is really needing a $700,000 loan on $1 million purchase, let's just say, and he can't do the deal unless he can borrow that much money. And if we're not comfortable with the property really in the whole transaction, we'll say, look, we're not comfortable lending you 700,000 on this $1 million purchase. What other real estate do you have that has good equity? And we'll look to cross collateralize. So we've done a lot of deals like that. I think one of our case studies is also like that. So yeah, that's
Look
a
at that later.
big tool we have to adjust our risk parameters.
Sweet. Awesome. That I like you digging into that, almost going into some of those underwriting standards. How about even defaults? This is the business of lending money and debt.
Mm.
How do you guys manage defaults?
Try to avoid
Yeah,
it.
of course.
So
Yeah.
there are some companies, and I'll say that with big bold letters, there are some companies that they're more, they have a lend to own mentality. Like, I'm going to lend you this, but shoot, if you don't pay the loan, I'm okay with that. I'm just going to take the property. That's not what we're designed to do. We like performance. We don't like to go through defaults. They're time consuming. They can be expensive. There's uncertainty, mostly with timing.
Mhm.
Eventually, it'll happen. It's just sometimes in certain states, it can take longer to, pursue foreclosure. Basically, we just mitigate that. I mean, we've got close to like a 1, maybe 2%, 1.5% default rate. It's very low. We've had even cases where if a direct investor had a loan and the borrower stopped performing, we asked and they didn't want to wait on the foreclosure. They said, "Are you willing to buy us out?" And we would do it just to, and
Yeah.
again, it's not a guarantee, but just to kind of help out and smooth things over, make sure that they're getting what they signed up for. Now, again, it's not a promise or anything like that, but a lot of times the defaults can turn into a windfall if you're willing to wait. Because if we're lending 50, 60 cents on the dollar. We've got one loan that a direct investor took last year, and it was close to 200,000 on a $2.3 million property. And that thing got snapped up very, very quickly. There's cases like that where they're kind of like, I'm willing to sit it out, right? But that, again, that's not what we're designed for. We're designed for performance, designed for completely trying to mitigate default situations.
I feel like our time's flying. I really want to get to some of these case studies that you have, but I've got a couple of other questions if you don't mind to touch on before we get into the case studies. One of those is tied to the self-directed retirement account angle. You being a self-directed retirement investor, I'm positive you got clients that are also self-directed retirement investors. In your perspective, why does passive mortgage investing pair well with a self-directed IRA or even a solo 401k?
Yeah. Yeah, I would say probably more than half of our investors invest through self-directed IRAs.
Okay, wow.
That pairs very well with this investment because this is taxable income. So there's no depreciation that you get like with real estate ownership. So it's an income play. It's designed for people who are looking for consistent income based on their investment. And you say, well, why would a self-directed IRA investor want income? Well, maybe they're not willing to ride through the volatility of the public markets. Maybe they're getting close to the point in age where they're taking RMDs, required minimum distributions. They're looking at the next 5 to 10 years as their safe horizon, but they know they need to outperform the market or want to outperform the market and do better than what they can get with annuities or bonds, right? So it works really well with that. You get the consistency. So some of our investors are actually living off their self-directed IRA income. Some of them just don't want the volatility. So again, with a self-directed IRA, you get all the benefits of the traditional or the Roth tax benefits. So everything that it's earned, right? Again, talk to your CPA and tax professional, but everything that it earns stays inside the IRA. That's either tax deferred or tax exempt, depending as with a traditional or Roth, right? So that does pair very well with us because there are no real tax benefits to this type of investing, not like real estate.
As I think through the asset classes that our clients are exploring and what they have in their self-directed IRA, it's so good to hear what you just shared and how it could pair well with maybe the mix that they're looking for within their IRA. They might have, one particular asset class that's more long-term, venture capital. They might have some precious metals, so to just kind of point out how almost half of your clients or your investors are using self-directed retirement accounts and that it's really a nice income play short term 9 to 12 months like you pointed out initially could be just a phenomenal asset to place within your IRA. Let me ask you one more question before we get into some of these case studies. This is more tied to liquidity events. How can investors transition from, active asset management into more passive income with this type of asset class?
Transition from active to passive, meaning like a real estate investor who owns real
Yeah,
estate.
yeah, exactly.
Yeah, you'd have to bite the bullet on any capital gains. So you'd have to sell the asset or you can borrow against it. I've had clients who have hedged. That's fortunately coming back into vogue because of interest rates dropping, a couple
Yeah.
of years ago. I mean, you can still make a spread, right? So on average, we're earning our investors close to 11% net net. So if you can borrow capital, obviously it was better. I have clients who have $1 million lines of credit on their properties and they're still at 2%. Those are phasing out, obviously, and you can't get that
Yeah.
nowadays. And they can make the spread, right? They could borrow on the equity in their property and make the spread between their cost of capital and what we're earning them. So yeah, you're pretty much your two options if you're a real estate investor is to either number one, sell, number two, and we have a lot of clients doing that right now with condos in Hawaii. Condos are challenging right now. The market's a little soft because of insurance premiums going up dramatically. So HOA fees are going up quite a bit, and then the rents aren't quite rising as much. So it makes that kind of as an investment less and less lucrative. Plus, in Hawaii, we have to pay GE taxes on gross rents and things like that. So I have some clients taking chips off the table, selling their condo. Some of them will even get more creative and do seller financing. So instead of paying the capital gains that they have on it, they'll sell it to a borrower. They'll get a certain amount of cash up front, and then they finance it for them at whatever kind of yield they can earn. And then they'll take that down payment and actually invest it with us. Bottom line is you can sell real estate, cash it out, you can leverage it, right? Assuming you can make the spread and that's desirable for you. So if you can borrow at 6%, let's just say mortgage wise against your real estate and then turn around, invest it and earn 11, then theoretically you're at a 5%, differential. And then you're still hanging on to the benefits of your real estate too. So I've had clients do that too. That's a little bit more sophisticated strategy. You got to understand what you're getting into. But if yeah, in regards to active management from a real estate investing standpoint, that's what you'd have to do.
Reed, do you mind sharing some of the slides that you put together for us? I know you've got case studies that you'd like to share with the audience. Go ahead and take your time there, set yourself up and share your screen when you're ready.
Okay, so these are investments that we've already either have on our books or these loans have already been paid off. There might be a couple in here that are actually active. So this is a good example. We lent to a borrower in Kailua Kona, that's on the Big Island of Hawaii. We appraised the property at 1.43 million. We lent them 65%. So we lent them 1.43 million, but the property appraised at 2.2. So this
Okay.
was a residential lot. There was no home on it. Our borrower is from the Northwest. Basically, he is building a very high-end luxury home right next door. So he owns these two lots. One is being built on. We took collateral on the free and clear lot right next to it, and we appraised it at 2.2. We lent him 65% of the value, and he was going to use that money to help finish the construction on the adjacent lot. And basically, he needed to move quick. When you're building a high-end home, he had a liquidity crunch. He has other assets, and obviously this is one of them. He needs to liquefy his asset or borrow against it in order to finish his project. So basically, we did a 12-month loan for him at 65% loan to value. He had excellent credit. He actually had very strong income. Getting a land loan in Hawaii is challenging. Not a lot of banks like to do it, although he probably could have qualified for it, but he didn't have the time to wait. They wanted a number of, things from him that were going to basically run him through red tape. And we came in, were able to deliver it much, much quicker, albeit at a much higher cost. But it worked. It worked for him. He understood the cost of capital. So we lent him 1.43 million as a 12-month term, and our capital investors earning 11% on that. So that's a monthly income of about 13 and some change.
Awesome.
All right, so condotels. So we lent to a borrower who's acquiring a condotel in Honolulu. Condotels are legal short-term rentals. So in order to legally short-term rent, it has to be zoned appropriately for it. It's very important. There's no Airbnb out of single-family homes or things like that here. And that was a big, big backlash. So these are specifically designed to be rented out on a short-term basis, nightly. So we had an investor, he's actually an existing client. So acquiring the property for 550, it appraised at 550. We lend him 406. It was a 12-month term, very similar, 11% net return to our capital investor. These are all first liens. His situation was he actually owned two or three other units in that same building. So number one, we already have the track record with him. We've helped him in the past. Basically, he was getting this property at a very good discount if he could close quickly, and so we were able to come through for him on that. And this one's on our books and been performing great for the past 6 months, somewhere around there.
I noticed the loan to value, nearly 74%, seemed a little higher than what you were mentioning earlier. Is that kind of a one-off, or is that actually in line with what you guys typically lend on?
Yeah, so on acquisition, we'll go up to 80%, but that's kind of rare. Our average LTV across our whole portfolio is between 50 and 60. So, but in cases where we can see the borrower's performance being there, we like the asset class. It's not in some rural town, These properties are trading very frequently. There's
Got it.
liquidity in the market for that kind of real estate, and it's in our backyard. Then we can get more aggressive on rate,
Cool.
yield, or leverage. Yeah. So here's another one going the other way. So we just closed on this one, I think, in February this year, last month. Basically, this is in Virginia, Newport News, Virginia. We were approached by a mortgage broker. So some of our deals either come to us directly by borrowers who find us. Some come to us by intermediaries, like a mortgage broker. And then mortgage brokers will have clients, some of them all over the country. And then their job is to kind of pitch the deal to us, right? And then our job is to kind of bring it down to earth and say, well, let's slow down, okay? This is probably more looking like this. This is looking like this. Mortgage brokers provide a very good, deal flow to us, especially once we build relationships with them. They can see that we can deliver. We like how they package their deals to us, etc. So this was a real estate investor already owned a property, a mixed-use property in Virginia. He had a seller, no, he had a private mortgage on it already. He had started renovations, and now his scope of work got a little bit larger. So the goal was to pay off the old loan, try to see if we could lend him more money to renovate it, knowing that the future value of the property was going to be X. Now, what we did on this one, as we got into it, we started to see a little bit more risk on the deal. So we came back and had to retrade this. We call it retrading, means we have to renegotiate the terms, the structure, everything. So fortunately, we kind of saw some things up front that were, I always like to give our borrowers, our mortgage brokers, our investors like a sense of what they might happen around the corner, right? So I like to be proactive about things like that. So actually I told him that the borrower that there's a chance that we may not be able to lend you the total loan amount that you see after we get into underwriting. So in preparation of that, what other collateral do you have? And then he showed us a whole schedule of real estate with 10, 15 properties, some of them free and clear. And so that gave me the confidence. I said, I don't know if we're going to need that yet, but I want to be prepared. So I'm glad you showed that to me. I'm glad we have it. Once we get into underwriting a little bit deeper, we'll come back to this, this situation. So it did happen where we were not comfortable lending him the original requested loan amount size without additional collateral. So we cross collateralized a free and clear condo that he had in the area, and that gave us the comfort to deploy the total loan amount requests of 1.136. So we have a couple different parameters. I don't want to go too much detail here, but as is value is the property of the value of the property as is, as it currently sits. After repair values, what is it going to be worth after it's done, right? So we want to be limited on both sides. So when the project's finished, in this example, he's needing some construction money. Now, we don't just give them the construction money up front. We actually hold it back. That's called a construction holdback. So we lend them a certain amount up front to pay off that first note. And our day one exposure was 44% of the total asset value of the property. And then we also got an appraisal opinion, a whole appraisal report showing us what the property was going to be worth once the renovations were completed. So then that is what we base our total loan amount against, because that includes the construction budget. So again, our exiting or ARV value, loan to ARV, was actually 49%. So both ends, we now felt very comfortable. And this one, again, because of kind of the structure and the work that went into it, we were able to get our capital investor a return of 12%. That's net net. So on 1.136 million investment, they're earning 136,000 over the next 12 months.
Would you say, Reed, that your borrower in that instance in Virginia, would you say when he saw the terms that it was competitive? As an investor, I'm not sure, or sorry, as a borrower, I'm not sure what kind of shopping they're doing. Or maybe they come to you through a broker like you were talking about, but do they jump on these opportunities pretty quick, knowing that that rate or those terms are favorable for them as well as favorable for you and your investors?
That's a good question. That's something that we look at. So if I throw out something there in it, some of this is negotiable, right? Some is
Yeah.
not. I just say this is the best we can do.
Yeah.
There's a lot of that. So
Yep.
As far as getting a loan, I mean, I have to be sometimes competitive, but our value proposition as a lender is not being competitive on not with these kind of loans. Again, if I'm doing other long-term loans where we're not keeping on our books, I can get extremely competitive with rate. But those loans, not what we're talking about here. With here, it's kind of a take it or leave it mentality. So now if somebody is just too eager to take, that becomes kind of notice that, I wouldn't call it as far as a red flag. It's more like, wow, he's just too easy. What's going on? So yes, there is a balance between, in the same way I want to make sure I'm a good fit for a capital investor, I want to make sure I'm a good fit for a borrower. Sometimes I'll tell them, maybe we're not the best fit for you. And that's okay, right? We have plenty of deals. The beauty of the way we're designed and our brand and our visibility is we have substantial deal flow. And I'm turning a lot of deals down. Either I'm turning it down or the borrower is saying, no, the rate's too high. And that's okay. So we just got to do our at bats. That's what matters. So we can be picky about what and who we lend on, and make sure
Right.
that we're getting the yield that we want for my
Love it.
investors.
Right on.
Yeah. So here's another quick one. This is also on the Big Island. This one was also a cross collateral deal. Existing client, great performer, paid loans on time every month. He's a licensed general contractor. He had a property that he wanted to build a single family home investment on. Again, wanted a certain loan request size, didn't quite work. I said, what other properties do you have? He had a free and clear property down the road that we appraised and then gave us the comfort to lend him $1 million, but we took a first lien on both properties. So our going in loan to value was 48%, loan to after repair value 54%. Just quick note on that. That basically means that the market value of the property once it's finished is going to be, 46% higher than what we're owed. That's our protection, right? So at the end of the day, the borrower owes us $1 million once we fully deploy the construction money, and the property is theoretically worth 1.8. So even with fluctuations in market or timing, or if we had to take back the property and unload it because we don't want to own it, just unload it, fire sell it. There's different approaches there. Sometimes it's speed, sometimes it's, well, let's take the time to market the property appropriately. The market is conducive to this, and it might take a little bit longer to sell, but I feel like there's a good chance we'll be able to yield out a higher sale price. Again, this is only a default situation, but yeah, that's important to understand. So at the end of the day, we've got a theoretical value of verified by appraisals, 1.8 million. We're owed $1 million. That's your protection.
For sure. And I just wanted to point out the term on that, 6 months. That's one of the, your average 9 to 12, like you mentioned earlier. That seems like a shorter term
Yeah.
for the
Yeah.
investor.
I have some investors that like the short-term notes, and some of them say, well, that's too short. I'm gonna find another deal by the time this gets done. So, there's that part of it. But yeah, obviously, invest in the type of deal that you want that makes sense for
Yeah.
you and your goals.
Yeah.
There's also the borrower side. Sometimes they want 6 months because they know they can get this done quick, and sometimes we're comfortable. So we got to balance all those factors out. But when I'm going in putting a loan together, I'm not thinking about, oh, let me do more 12-month loans because that's what my capital investors want. I mean, it may come, might be thinking that from a business standpoint, but it's more about like what is appropriate for this deal. And then, if this happens to be a good fit for a capital investor, so be it. If it's not, then don't invest in
Yeah.
it.
No, I'm glad you highlighted.
Yeah. So yeah, this one was earning 10.4, and I could see his ability to get this done because of permits were already in place. He's a licensed GC. He's an existing client. I've seen how he's performed. So he's actually going through his construction draws right now. We just issued his second construction draw a few weeks ago. So yeah, and he's making every payment on time. All right. So last one. This was back to the other side of the country. This is in Green Lane, Philadelphia, smaller town. Okay. So that comes into consideration. I wouldn't call it go as far as to say rural, but it's kind of like a suburb of, I think this one was in Philadelphia suburb, but this was a owner user. Now, owner user in the commercial lending world doesn't mean owner occupied. Keep in mind, we do not lend to owner occupants with any of these mortgages. Reason for that is number one, you can't charge the yield that we need to earn for our investors. Number two, you have to deal with a myriad of consumer regulations, things like that. And number three, I don't like the idea of having to take somebody's home. So
Yeah.
these are to be strictly lent to sophisticated business owners, business operators, commercial property. They're people in it for profit, right? And they're sophisticated enough to understand the cost of capital, what they're getting into, how this will help them in their project, and what they have at risk, right? they could lose the property if they don't perform. So that's who we lend to. Owner user means he's running his business out of it.
Got
So
it.
basically, he's run his business out of this location actually for I think it was a long time. I want to say like 20 or 30 years or something like that.
Looking in
And
the windows, it feels that way.
yeah, yeah. And he had a chance to buy it with a lease to own. So for the past X months, his lease payments have been applied towards a purchase price, which is $1,050,000. And so we came in and now he needed to close. He needed to finish paying off the seller completely. He is in line to get an SBA loan, and that's the exit, how we're going to get paid off, which is another important thing that we have to verify and vet and understand and get comfortable with when underwriting. But anyway, we lent him 630,000 to buy the property. We appraised it at 1,050,000, and this was returning a beautiful 11.6% yield.
To say the least. Beautiful. That's awesome. Cool.
Yeah.
Reed, this has been good stuff. Yeah, this is important. I want you to keep that up there. Is this the best way to get in touch with you there?
Yep. Yeah, you can just call our office. As for me, if I'm in a meeting or something, my team will just take a message, or you can just tell them I want to schedule a meeting.
Sweet.
Yeah, we can set up. Usually, the first thing is we just get on the phone, chat, understand where the investor's at, what their goals are, see if it's a good fit, and then kind of continue things from there.
Love that. Looks like you got a waiting list as well. You're on socials. I can see you're on socials there. You probably put out some information there every once in a while for investors to take a look at.
Yeah, yeah.
Cool.
There's some on there.
Cool. Right on. Well, Reed, so happy that you took the time. We're right here at the top of the hour. Appreciate you so much being here and sharing your insights, your expertise, and what you and your firm has put together. So I would encourage anybody listening right now to reach out to Reed. Definitely, if you're a self-directed retirement investor, look at this as an opportunity for you to diversify your portfolio. Get in touch with Reed. If you don't have a self-directed retirement account, take it from us, take it from Reed. There are plenty of investors in his shop that are using retirement funds to invest in this type of asset class. So it obviously fits really well with anybody who might be interested in exploring that option. But with that being said, Reed, thanks so much again. Appreciate you coming on.
Yeah, no, thanks for having us, Joel. Really appreciate it.
Of course, anytime. We'll have you back again in the future. And everybody, thank you so much for joining and have a great day. We'll talk to you later. Bye-bye.